Welcome, everybody. Good to see you on this Friday in late June. I hope you're staying cool. We are going to talk about the singular opportunity in the defense sector. I'm excited to get together with you all today and go over how we do this work, how we make it possible to find the right stocks in a sector, especially one like defense, that's hot, that's interesting, and a lot of people are flowing into it, and therefore that makes it dangerous. And so let me first give you some background on new constructs and how things work. The first thing we have to do, as always, is share our disclosures and disclaimers. We are not providing investment advice. We are not advisors. We do not intend to be. We do not want to be. We are here to provide insights, intelligence that you can't get anyplace else. Always, I like to hear from you in the chat. Complaints, compliments. I actually prefer complaints because that's something I can fix. Let us know what we can do better. We want to learn from you. And no one knows better about what we can do better than you, our clients and our audience and our friends. And if we have time at the end, I will take a couple of tickers and run them through the system and give you some answers about what our research says on your stocks. So, quote of the day, I've used this a couple times, and it was used first by a good friend of mine, the late Mike Grimness, one of the greatest sales guys I ever worked with, and great friend. And he used to use this in our meetings with institutional investors all the time. We toured the country together, meeting with some of the top institutional investors around the world. And he would always say, when he talked about new constructs on my behalf, it's like Ben Hogan says, golf is not a game of good shots, it's a game of bad shots, right? It's not so much about how well you hit the good shots, it's how bad the bad ones go. We've all seen it in the big tournaments. When a golfer melts down and he keeps sort of digging into that one bad shot or that one bad position. And the same is true about investing. It really is. You can cut out the bad ones. You're going to do way better. And these days, it's just harder and harder because there's so much propaganda narrative coming at you every day to buy this, buy this, buy that, buy that. I was on Wall Street and I saw how the sausage was made. And I decided when I started new constructs, I was going to create something new and better to make the investing world a better place. Because ultimately, our mission is to improve the integrity of the capital markets. And we demonstrate the efficacy of our ontology, of our AI agent for investing with great stock picking performance. What matters more than actually good recommendations, good ideas, good insights. And that's what we have. We've been ranked number one on SumZero in multiple categories for 48 straight months. MIT Sloan School of Business, the Harvard Business School, Ernst & Young, the Journal of Financial Economics, published papers proving the superiority of our data, of our analytics, our models, and our stock ratings. Even better, the performance of our actively traded indexes based on our research proves value add as well. I mean, what's better than live active performance? In the first quarter, we're almost at the end of the second quarter, so we'll update it soon, but in the first quarter, the very attractive stocks index beat the S&P by 9%. Over the last 5 years, it's beat by 59%. The core earnings weighted S&P 500. This is the S&P 500 stocks weighted based on core earnings, our proprietary metric, instead of market cap. So you take the same stocks, like we don't even have to pick the stocks and we can still outperform, right? We let someone else pick the stocks and we'll still beat them because we'll weight our stocks based on core earnings instead of market cap. And in the first quarter, that strategy beat the S&P by 1%. Over the last 5 years, it's beat the S&P by 33%. These indices are managed by Bloomberg and they're not available for the public to purchase. But our research is. These indices are all based on our research. That's available, but the indices themselves are not. Here's the other thing I want you to understand you're up against. 96% of stocks covered by Wall Street get a buy or a hold. Is that right? 96% of stocks are good to buy? Come on. How inefficient would the stock market have to be for 96% of stocks to be undervalued? It's ridiculous, right? It implies an incredibly inefficient market. There they are, year after year, day after day, boldly putting out their absolute junk ratings. Why? Because their paychecks depend on you buying stocks. So they want to buy you everything, right? When you go to a used car lot, they don't tell you, here are the good stock, here are the good cars, and here are the bad cars. They're trying to sell you all of them because that's how they make their profits. Buy ratings, 57%. How inefficient does the stock market have to be for 57% of all stocks to be buys or to be undervalued? It's ridiculous. Maybe more like 13% makes sense, which is where we are. The other thing you need to understand is like when you really dig into financials, I'm going to show you something really powerful here. When you dig into the real financials for companies like Nvidia, Apple, Alphabet, Meta, etc., the gap between their stock valuations and their current cash flows is staggering. Wall Street doesn't want you to see this gap. They prefer you don't have any idea how big it might be, because if you'd be terrified if you knew the whole truth. But they do give us estimates, right? They give us a few years of estimates as if that's enough to understand the full life cycle of a cash flow. And by the way, right, what did Harvard Business School prove? And what do these indexes from Bloomberg prove? Traditional legacy gap earnings, Wall Street earnings estimates are not reliable. Core earnings are way better. So they give you crappy numbers for a short amount of time. And then we're supposed to value the stock based on that. If that doesn't sound like a shell game, I don't know what is. Right? There's some magic X factor after earnings that are going to explain the value of the stock. Doesn't make sense. So what we're going to do, and I'm going to do right now, is show you the truth, what you deserve. Our models will show you all the cash flows baked into the stock prices, not just a few years of estimates that you provide some magical multiple to. That's going to like, oh, okay, 20 times that number. Now that's how we get to the value. Why 20 times? Well, I guess that implies at least 20 years of that earnings number, but we know that earnings number is not going to stay the same. So why do we just have some magic multiple do all the work? There's no need to. But Wall Street doesn't want you to see what I'm about to show you, because the gap between what the implied cash flows are and the actual earnings estimates is staggering. Here it is for Tesla. All right, this is from a while ago, 276 a share. The red here, these are the implied cash flows in a discounted cash flow model that are required to get the model to justify 276 bucks or get the model to produce 276 bucks. This is the free cash flow per share. The analyst estimates, just this blue, this little bit. What kind of price does that justify? Same is true for Nvidia at 117. It's way above that now, right? But look how much the actual free cash flow per share over time has to be compared to the analyst estimates. What kind of share price does that imply? Not even close. So I hope I made my point clear here. EPS estimates are not nearly enough to make informed investment decisions. Definitely not in this environment. So how do we do it? What's our secret edge to outperform even the most chaotic markets? Well, if you've been a part of our community for a long time, you know that our edge is our robo-analyst technology. To put it in more current terms, it's our AI agent for finance and investing. We've got the technology to take the data from the source to its highest and best use to produce idiosyncratic alpha. Full stop. We take the data from the source all the way to its highest and best use, which is to produce idiosyncratic alpha. No one's ever done that in the history of the world, which is why what we have is special. It's why some of the top institutions, executives, and investors in the world use it. But don't worry, we make it simple. Why? Because I'm not here to bamboozle you with outlandish claims and complex terms and systems. Green means good, red means bad. That's my value add. Didn't mean to rhyme, but it came out all right. So the idea here is that like the value in anything in the world, like whether it's AI or whether it's a software program or whether it's even a book, is to synthesize a body of experiences, a body of data, a body of information down to a point that you can use, you can act on. That's what we're doing. We are synthesizing an enormous amount of data, information, analytics to give you an answer. We're the only stock system with a patent behind it. The comprehensive nature of our research entails countless pages of data and documentation, including information from balance sheets, income statements, cash flow statements, footnotes, dozens of other disclosures. We're doing the full work. Why else would we be able to generate alpha If we just had a piece of the data, we would be any good. We had to do the whole thing, and we had to organize all this data into an ontology, into a system that produced incremental insight. Here's a sneak peek of how it looks inside our institutional membership, right? We actually show people the proof right back to the original filing. Look at this. This is the actual filing right here. And we had a system that tracks the data from the balance sheet, the income statement, the cash flow statement. Then we say, oh, here's the adjustments. Here are the adjustments from hidden items. Anybody know what hidden items are? Anybody? We got any people who've been with us for a while that know what a hidden item is? Put it in the chat if you know what hidden means. Hidden means you can't find it on the income statement. So typically means it's in the footnotes. In the footnotes. And you can see, look, we show you where it comes from. Bam, bam. This one's been selected, automatically jumps to the filing where you can see that, right? I don't believe there's anyone else in the world that does that. Yeah, some firms will take you to the filings, but will they show you where they get data from the footnotes that affects financial performance, that creates an abnormal measure of earnings, that creates idiosyncratic alpha? No, no one else does that. Yeah, so let's do a live demonstration. Let me show you how this works. I got some great comments in here. I hope some of you guys can see this. Got a senior partner of a major Wall Street investment bank. Yeah, if you have a sell, you would not be invited to the next financing. Exactly, right? I mean, you can't have sell ratings, otherwise you don't make any money. All right, so let's go through how the system works. Let's start with our screening tool. So this is from our professional membership. And what it allows you to do is screen our entire universe of companies. So this is like all sectors. We can screen based on price, dividend yield, market cap, but most importantly, rating. And I want to emphasize that this is the most powerful stock screening tool in the world, hands down, not even close. These stock ratings are proven to outperform Wall Street ratings. The very attractive stocks fund or index right here on Bloomberg been a tremendous outperformer. Let's go here. I showed you the slide before, the performance. Let's compare to the S&P 500 over the last 5 years. Last 1 year, 5 year, 1 year. I mean, it beats it, right? Our ratings are super valuable. So being able to screen the entire universe of stocks based on these ratings that have synthesized all this huge amounts of information to give you an answer you can trust, incredibly powerful. Professional membership is $1,000 a month. You know how much it would cost our clients to replicate this? I know because they tell me millions of dollars a month. So it's an incredible deal. And that's not what I'm here to tell you about. I'm going to show you how this works in a second. But you can also screen on things like return on invested capital. Who calculates return on invested capital better than anybody else in the world? New constructs. Not even close. 2-year average free cash flow yield. Best free cash flow yield metric in the market, hands down. Price to economic book value, one of my favorite metrics because it's like a super cool way to really see how much risk is in a stock price. It's the inverse of PVGO as a percentage of stock price. I love that one too. And then there's the growth appreciation period, the market implied growth appreciation period, based on a reverse discounted cash flow model, the best valuation model in the business. All right, but I digress. The point is you can screen very quickly. And so what we did before our meeting today is go in and say, let's go into industrials, aerospace and defense, and let's go find the best stocks. Now, I'm only showing you the unattractive and very unattractive because I'm not giving away the golden goose for free today. Sorry, folks. We can look up from a few other stocks, but I'm not giving away the golden goose. What I'm showing you is how, if I wanted to, I could just click here and here. Go to filter, bam, and I would get all of the very attractive and attractive stocks. What we did today is the unattractive and very unattractive. And you can see there's a lot. Now I will tell you that when I did run this screen for all defense sector stocks, there was only one stock that showed up as attractive. But let's talk about what makes these things unattractive. We've talked about bad stocks, bad dividends, et cetera. Let's just pick one of these. Let's pick a big one, RTX. What do we got here? Well, you get an unattractive rating because you got actually poor profitability. No matter what the accounting earnings show, This company's got a 5% return on invested capital. That's bottom quintile. Then you've got some very expensive valuation metrics here. Free cash flow is not bad, but the valuation is super expensive, especially for a defense sector stock. I mean, this means it's a crowded trade. This is kind of an underlying theme behind what's happening in the defense sector. When a sector gets hot and Wall Street starts getting you to pour money, influencing people to pour money into it, you've missed the boat, my friends. The entry points are past. They're no good because everyone else has figured it out. To my point earlier, if Wall Street's telling you that 56% of all stocks are undervalued or a buy, or 96% are a buy or hold, so they're undervalued enough for you to keep holding them, the market's incredibly inefficient, right? And we know that's not true. The market is semi-efficient. Most stocks are appropriately valued. You got pockets of undervalued and pockets of overvalued. That's where you need to focus. Point being that stocks don't stay inefficient, or markets don't stay inefficient on certain stocks for very long. Stocks don't stay undervalued forever. So when something gets hot and money rushes in, what do you got to do? You got to move fast. You got to go to where the puck is going. You got to buy the stocks before everyone figures it out. Defense sector, all these attractive and very unattractive stocks, it's crowded. Everybody's figured it out. You're going to see stocks with a lot of red up here on the right in terms of valuation. When you marry that to poor quality of earnings or not a great business model, you've got a bad stock, my friends. That's what unattractive means. Let's come down here to very unattractive. Yeah, you might think, oh, if I get in one of these sort of these new companies, these new defense companies, I mean, they're doing something cool with drones. Okay, well, know what you're getting into. I mean, this is a business it's not looking too good. Now, it could be a startup, but look, when you see valuation like this means the stock price is already implying an incredibly profitable future. In fact, we might even do a quick little demo on that. But you can see profits flat, number of shares going way up. That's not good for you. Probably going to keep doing that because they need to issue cash. They need to issue shares to cover their cash burn. So we'll come down here and we'll see their NOPAT margins, terribly negative, free cash flow, negative, 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 right? Let's look at our economic book value. The economic book value, golly, it was negative 400,000 a share. Okay, now it's up to negative 24 bucks a share. Things are getting better. Point being, look at the stock price. Is this right? Is it 12,000 down to 152? Yeah, somebody got played here. Somebody got played. AREB. AREB. American Rebel Holdings. Maybe this is just some junk. Oh my gosh. Okay. Well, I didn't really know about this stock before we started going through it. I picked it at random, but I guess it's a pretty darn good example of how much Wall Street's willing to fool you. I got lucky there. Picked a great one. So you get the idea. We've screened through everything. We're highlighting the red flags. We're showing you where the bodies are buried so you don't have to step on the landmines yourself. So let's finish up here. We're offering you today a singular opportunity in the defense boom. We are making a special offer to give you this only attractive rated stock today. I've shown you how the entire sector, except for this one stock, is bad. There is one good one. And we do think that the way things are going in the defense sector, the entry point for this stock is still good. It will not be that way for long. Trust me, when we do these special stock picks and bundles, these stocks tend to go up fast, like right after we publish, because people like you are out there, you get the pick and you go buy it because you realize the window's not going to be open forever and you better get in while the getting is good. So what do we like about this? One company, massive tailwinds, right? Obviously, the defense sector around the world. We've finally woken up to the fact that not everybody's our friend. And the people that have been our friends, they can't afford to protect themselves. So everyone's going to have to spend a lot on defense because, a lot of the firms that were, we thought would be allies have become enemies. The headlines say it all. Unprecedented rise in global military expenditure. NATO allies have agreed to spend more. Lawmakers propose a $25 billion golden fund for the Golden Dome. These aren't just news headlines, they're catalysts. And the company we've uncovered stands to benefit from all three and more. Why does an attractive rated stock stand out? Only 14% of our coverage gets an attractive or better rating. The company's got decades-long contracts with governments and agencies, multiple billion-dollar businesses across aeronautics, weapons, space, and more, a healthy dividend, 20 years of dividend growth, and consistent profit growth over 2 decades. Why should you pay attention? Because smart allocators are moving into cash generating businesses with undervalued stock prices. You can't just play the momentum game anymore. At some point, everything's expensive, everything's at a peak. It's time to zig when the market is zagging and get into real safe stocks that give you your cake and eat it too. You're getting a dividend, you're getting great profits, but you're getting a cheap stock price. Why not? Why? Why not take a cheap stock price when you can get it when you have everything else as well? When you sign up for this special offer, you're going to get immediate access to our professional level report on the only attractive rated defense stock. This is a report that is basically an entire financial model in one document. It's about 8 pages, and it has indices with all kinds of data and analytics in there. And this is one of the favorite products of our institutional clients. I would tell you that in order for you to build a model like the one that you will get in this report, to build a model to produce all the data, I mean, I think if you were to go out there and hire a Wall Street expert or any expert to go and build a model like that, I don't think you're going to get it for less than $25,000 to $50,000 for just one. For just one, 5 years of history. That's it. At least. You can probably pay somebody a lot less, but you're going to get junk. Get what you pay for, folks. Except the new constructs, you get an incredible value. You'll get charts with detailed history and trends for each element of the stock rating, details on the adjustments we make to the GAAP financial statements. We want you to see all the work we're doing because we're proud of it. Show me or name another Wall Street firm that will do that for you, or any other research firm that will show you all the adjustments they make for all the companies they cover. Put in the chat. If you give me one that's real, I'll give you a free report. I'll give you a free access to our most attractive stocks model portfolio. If you can name another firm that has anywhere close to the transparency that we have. The bottom line is that this defense stock combines yield, strong, consistent profit growth, and capital appreciation upside potential, the kind of trifecta you almost never see in today's market. And for a limited time, you can get this stock pick at a special price, $4.99. For just 1 month of access to our professional membership, that's $1,000, and that's what you need to find this stock. What I just demonstrated to you, $499 for a great stock pick, based on millions of dollars of research, training, hundreds and hundreds of thousands of filings, and the best and only AI agent for investing. We think that's an incredible deal. Now go and click the link in the chat that we provided. Great. All right, I'm going to take some questions here. Common question number one. As a first-time user, how can I confidently navigate and make the most of this report? That report will come with a tutorial that shows you exactly how to get the most from it. And we have tons of tutorials and videos and trainings on the site. We do things weekly, daily, sometimes, and monthly. You can ask me anything. You know, look, even I took Richard's question at the beginning, which was giving me a hard time for being late. Look, I'm here. I stand in front of you as a real human with a special technology and tool and advantage to share with you. I'm absolutely an open book on how we do it, why we do it, and want to help you understand how to take advantage of it. It's my reason for being, my professional reason for being. All right, question number two. How do I find the best stocks inside a particular industry? You do what I showed you just how to do a second ago. You use our stock screener. We also deliver and update stocks throughout all of our model portfolios monthly. You can sign up for a model portfolio. We have safest dividend stocks, dividend growth stocks, the most attractive stocks, the most dangerous stocks, the companies that align executive compensation with ROIC. It's another one of my favorite model portfolios. So we do all this stuff, and that's the idea, right? I'm going to go create this awesome technology, this AI agent for investing. I'm going to put it to work. Common question number three. Are the attractive and very attractive stocks in the membership guaranteed to have a double or triple digit gain in the next year? No, nothing is guaranteed. Nothing in life is guaranteed. No stock rating system can ever promise a specific return. While we're highly selective, with which stocks we grant as attractive, we cannot guarantee the stock will explode in the near future. No, there's no guarantees. Like if I can guarantee the stocks, we'd all be doing this meeting on my jet or my yacht with a drink in our hand, celebrating our incredible performance. Because, yeah, 59% of all stocks are good buys, right? Yeah, no, it's not that easy. Investing is hard. And I'm going to be truthful with you and not pretend that we can provide outlandish returns. We don't do that. We're not your traditional financial publisher. We're a breed above. We're something special. We're different. Nobody's done what we've done before. No one's built the kind of technology we have. No one's ever embedded or imbued technology with the subject matter expertise that we have. Common question number 4. What will you be covering during your monthly training calls? Everything. You can feel free to ask me whatever you want about anything we do. We're proud of our work. It's the best in the world, and we want everyone to understand and have access. That's it. I didn't create new constructs just to cater to big Wall Street insiders. Yes, they are my clients. They pay for the better research. Now, it's mostly hedge funds and quant funds. It is not the big Wall Street sell side firms. They don't want you to have what I do. They don't want their own people to have what I do. You know why? Because if their analysts had access to new constructs, they would have to quit, because then that analyst could not, in good conscience, publish the research praising the companies that the investment bankers want them to praise. It's a fact. I ran into this at Credit Suisse. When I was doing this kind of work at Credit Suisse, we did it all manually. But when I went to go meet with the tech team, the tech analysts during the tech bubble, they told me, we can't use your model, David, because then we can't sell these deals. We can't publish these fake numbers that we've been publishing that help the stocks go up. Flat to my face, said that. That's what I say. I've seen how it goes down on Wall Street. And that's why I think it's important for us to do what we're doing and give you the truth. That's exactly why we do what we do. So I've seen how they want to lie to you, how they want to trick you, and we're here to provide you with something better. Great question. Pick and shovel ideas for defense stocks. Great idea. We love the picks and shovels because those typically, the entry points for the pick and shovel plays, DL, stay open for a little bit longer. That's a great idea. And absolutely, I would be love to use our screener to start looking for some of those. I think that'd be something for us to do, as we have with the tech industry several years ago, before everything in tech got expensive. But I remember KLAC, TLA, KLA 10 Core, and a few other stocks. We wrote a paper on it, or a report. You can probably see it on the blog. It's probably free by now, on pick and shovel plays for the tech sector, and we crushed it. Those stocks crushed it. We picked NVIDIA when it was 25 cents a share, split adjusted. We were there early. We just let it go because it got so expensive. All right, everybody, make sure you have access to this link. If you want this stock based on millions of dollars of effort and research at an extreme discount to what it would cost you to build just one model, and you wouldn't know if that model would be worth building because you'd have to build one model in one company that's going to cost you 25 to 50 grand. And that's a big guess that it would be worth the investment on that one company. New Constructs is the opposite. We've built those super sophisticated models on all major publicly traded stocks in the US so that when we screen with a precision that creates incredible value. And we want to do that because we believe everybody deserves access to the truth and deserves access to better tools and an escape from Wall Street propaganda. All right, if there are no more questions, thanks for being with me today. And Richard, don't worry, man. I love the question. It was great. I like it when people are honest and tell me what's on their mind. And so at the end of this, if you don't mind, fill out the survey and tell me what you didn't like. Because again, the negative feedback is more valuable to me than the positive feedback, because I want to know what we need to fix and what we need to do better more than anything else. Thanks and have a great weekend.